Stock market is very liquid, right? I mean, you can sell your stocks, all of them, within a second if you want. That's not so possible with property investing.
Actually, liquidity or lack of liquidity sometimes is a big benefit. So we did a webinar last week in South Africa, and one of the advisors we were doing this with told me a story that in 2009 he bought a property, or 2008 in London, and he paid £350,000 for that property, and it was rented out. And then the financial crisis hit and he was panicking. His £350,000 property was worth £280,000. He was panicking, he was trying to sell it. And in the end, it didn't go through, and he kept the property because he couldn't find a buyer. And the property's worth £1.5 million now. So,
wow.
Today we are talking about something that I am being asked very, very frequently. Should I put my money into stocks, or should I take my money and invest in real estate?
What you would say nowadays, what is the right time or setup to get into property investing?
Well, obviously the biggest hurdle to any investing is money. It's a bit like with stock investing, you know, at some point you can listen and research, and everything you need to know is on the internet. You can research as much as you want. You find a good expert that you believe in, you understand, and you can have a good conversation with. You know, I would say the best thing to do is to keep it simple and not overcomplicate matters. Make sure you can get a mortgage on the property. If a bank won't lend you money on that property, there's something wrong with it. And so, you know, don't buy anything the bank doesn't want to invest in either.
You know, for everybody who wants to know more about Tim and his great journey into his empire of properties, then we created a whole guide that you can download on the link below.
Welcome to a brand new video, and today we are talking about something that I am being asked very, very frequently, okay? Should I put my money into stocks, like the stocks that we are talking about, or should I take my money and invest in real estate? Right? There's definitely huge pro and cons on both sides. Stocks are being, you know, very liquid, and you can start with basically $100, right? On the other side, you know, the volatility in properties is not that high like in stocks. Or you can also leverage, you know, with very less of, you know, down payment, a huge amount of money into properties, right? Like let's say you pay down 20% of the property, you're still working with the 100% of the value of the property, and many people are actually, you know, using the property as well with their family to live in, to save rent, and so on and so forth. So I brought in a guest that I cannot wait to introduce you to. His name is Tim. We will do a full introduction in a second, but he was one of the main people that I would love to ask for this video to come on and talk about property investment, because if you want to learn, you should learn from the very best. So without further ado, let's dive in.
So doing this special video about property investing, I thought who I can bring from our network to the show. And I thought about the very much expert into property investing, Tim Murphy, who's founder of the international company IP Global, more than $3 billion of properties under the belt, specialized in residential investment properties. And I think, you know, starting with that, I hope that's a suitable introduction for you, Tim. Thank you very much for coming on the show.
Very happy to be here. I think that sounds about right, Danny. Thank you.
So Tim, most of the people will hear about IP Global for the very first time. So give me like a very quick introduction into your company.
IP Global is, believe it or not, nearly 17 years old now. And as you said before, we've invested in nearly or over $3 billion of property. And what we basically do is we go and find real estate all over the world that we like the look of. And we advise our clients to buy it. But first we get access to it by investing in it ourselves. So we would work with a developer that we like in a location we really like, and make sure we get access to the asset. We help them with the legal process. We help them with lettings and management. We'll run the asset for them, and we'll help them to get a mortgage as well. So, but we don't take the money. The money goes to the developer. The money goes to the bank through your lawyer. So we don't handle our clients' money, nothing like that. The client will always own the property in their own name. It's their investment. We just help them along the way, and we help them to manage it. And it's very important that people understand that. And as I say, we invest alongside them as well. we probably normally advise you to buy in your own name. It's simpler, it's easier to borrow money than buying in a corporate. But some of our clients who buy many properties with us, we'll put them in a vehicle, in a corporate vehicle. But essentially, we're an advisor. We help you to buy real estate, and we, as I say, we've been doing it for a very long time, and we've done it in more than 15 countries now. We've bought real estate, and we have clients all over the world.
I want to start this with a very personal question because, when I grew up and property investing is something like very, very normal into families at some point in life. And, when I watched my parents investing into properties, they told me always, think about the location. And when I'm thinking about the future, how the world looks today, I'm very much consider myself as a technologist. So, I'm thinking like self-driving cars, right? Working from home, Zoom conversations rather than real meetings. So, for example, I'm thinking like people, instead of living inside the city close to their office, so they don't have that much of a drive to their office, they rather will sit in a self-driving car where they can work already in a couple of years, so they can maybe move a little bit more outside the city, right? So what's your take on that? What's the number one factor or the top three factors that you think is impossible? It's
interesting, isn't it? I think the world has changed beyond recognition in 2 years. You wouldn't think anything could happen that would change property investing in the way that COVID has and the way people are starting to live their lives. So there's no question about it. Buyers of real estate, investors in real estate have started to think more about, do I need to be buying apartments in central London or central Birmingham or Cape Town or Dubai or wherever, when people are thinking about working from home. But I think we need to let the dust settle a little bit on that, because people are returning to work and there will be some normality returning at some level. But of course, with technology and a change in, my kids will not work in the way that I worked, and maybe they never go to an office. But so it will change that nature of what does location actually mean. And perhaps we get a bit more into that as we get through this conversation. But I'll just touch on that briefly. I think developers already are starting to think about, how do we build our spaces for future apartments? Because if people are working even a day or 2 days a week at home, shouldn't we be thinking more about communal space, balconies, gardens within developments, places to play table tennis, get fit, go for a walk, sit on a bench? Because previously, if you're just working in an office 5-6 days a week and coming home to sleep, it wasn't so important. So I think you will see the way that developments are built in cities and suburbs to cities changing drastically. So there are more shared communal spaces, places people can go work on their laptops outside, or in shared environments where they can eat a sandwich or a bowl of rice. But I still don't think, from when I first started investing, and I just jotted down, Danny, that it's 30 years this October since I bought my first investment property, which is pretty scary when I think about how old that makes me. But I don't think that much has changed even in that time, because for me, the fundamentals still are, you don't buy anywhere unless you're comfortable with that location, meaning, do you have confidence that if it's an investment property, there's a demographic of people that will rent that property from you. So there needs to be a reason why people want to live in that location, be it work, be it commuting, transport, infrastructure. It still needs to hold steady that it's a place that people will rent it from you. And number two, is there going to be liquidity in that asset? So property is not as liquid as the stuff that you invest in and your followers invest in. But it still has an element of liquidity, and liquidity means I need to know there are people living and working in this area that will buy this from me in the future. And that they're not just investors, remember. 90+% of the people that will buy that property from you in the future are more likely to be owner-occupiers, people that will want to live, bring up their families or whatever in that particular property. So I've got to be comfortable, one, that it will yield, that people want to rent it, two, that people will want to buy from me when I want to cash out, and number three, as importantly for most people, that the asset is mortgageable, that I can borrow money on it, because most people can't get into this game unless they can borrow money. And in fact, most of the best returns are for assets for properties you can borrow money on. So those to me have been the most important three factors ever since the get-go, and that stays the same even now.
Okay, fantastic. One follow-up on that, I saw recently a very interesting statement by one of the biggest property developers here in the Middle East. The population in the Middle East is quite young and very tech-savvy. And what one of the property developers said, he looked into the credit card bills of his family, even though the wife might not like it that much. But what he saw was like, there was like almost daily the ordering of food, right? Food ordering. And he said, like, though we have two big kitchens in the house, you know, our family mostly orders food because it's easy, fast, right? And less preparation time and less effort. So he thinks like maybe the properties of the future, especially for maybe single middle-aged people, will have even no kitchens, right? And you just said it right, like you think like maybe the more importance of or the priority of people who invest in properties will be more into, you know, having a small garden, have an area to play a table tennis. So what do you think are the next big trends in properties if you are thinking about that statement?
Yeah, look, I think what they've done well in America that's just starting to find its way into places like the UK. We invest a lot of money in the UK and in Germany, and we think the property markets there are very buoyant and very strong for the medium long term, particularly places, apartment blocks. That's a great example there. Really, community living is what things are all about now. You shouldn't really want to be in a block of apartments where you've got all people living in different ways, because generally you have a similar demographic, people living in a similar way. And I think you absolutely would therefore want, as I said before, some community living, but things like someone to take deliveries. So having a concierge, or it doesn't need to be a concierge, it can just be someone that looks after that building. Having fridges actually in a concierge facility, so you can get your food delivered in the day while you're at work, or you're out going for a run, or you're with your kids, or whatever you're doing. Yeah. So that's stored for you. And that's what they call multi-family living, right? Or so it's building blocks in the future of apartments that are appropriate to the way people live now, as opposed to how they used to live in the past. So you talked about driverless cars. You're going to need future buildings will be regulated anyway in the right way, but they're going to need electric charging points for cars. They probably won't have car parking spaces for 300 cars, because probably people won't be owning a car each. There'll be shared cars, as they're always starting to be already, but they'll need electric points. There'll need to be places to have deliveries and things stored. So I think developers are already starting to take control of that and think about that, and planners as well. So, you know, in places like Birmingham in the UK, which is the second biggest city, and we are big fans of Birmingham, not least because I was born there, but we like it as an investment market. They're not even giving parking as part of planning permission anymore. Okay. So if you're buying an investment property, you think, oh, I must buy a property with a car park. Why? Most of the people that are going to rent that from you or buy it from you will not have a car, don't need a car, and will walk for 2 minutes and get on the tram, the electric tram, that will take them to a train station or to their office. The train station in Birmingham then will take them less than 50 minutes to get them into London on the new high-speed rail, electric.
Yeah.
So it's all changing. So again, I think those are some of the considerations for future properties.
Then I would like to ask you, and I think this is also the interest of our community, what is the, let's say, average and the biggest return of investment?
If you're leveraging it, even at 50%, so if you're borrowing half the asset value and you're getting a 10% return, then you're getting a 20% return on your capital, because of the benefits of leverage, which is one of the number one reasons why people buy real estate. So the key thing with real estate, and anyone that tells you different, don't talk to them, is that you're talking about a 5 and 10 to 10 year investment, because real estate is not as liquid as stocks. And if you're buying for, as people have done in Dubai, they regularly, when the market's hot, they queue up and they put down a deposit and they sell it again in a few months or a few days or even hours during the crazy times of Dubai. That's not a sensible way to buy real estate. You should be buying bricks and mortar to sit and hold, take a yield from. And the great thing about real estate is sometimes your yield will fall away a bit, and sometimes it will be better, but over the medium long term, your capital appreciation, if you buy well, will always be there. And you take the UK, London has doubled every 10 years, the property price in London every 10 years since the Second World War. So that's 70 years. Every 10 years for 70 years. And you could say something very similar about Manchester and Birmingham if you look at Berlin and most of the big cities in Germany and across Europe. If you're sensible, you buy well. you would be disappointed not to have doubled your money over a 5-year period, certainly 10-year period, very easily.
What do you would say nowadays? What is the right time or setup to get into property investing?
You know, I say this to everybody. It's the biggest hurdle. Well, obviously, the biggest hurdle to any investing is money. But the second biggest hurdle is having some courage, because a lot of people think about it and talk about it, and they have a beer and they say, oh, I'm going to buy a property, and they never get around to it. And then there's always the guy or the girl who did do it, and now they're sitting on 5 properties. You're like, I want to be them. Yeah. And it's a bit like with stock investing. You know, at some point you can listen and research, and there's no excuse anymore. Everything you need to know is on the internet. You can research as much as you want. Find a good expert that you believe in, you understand, and you can have a good conversation with. But ultimately, make that move and go invest in your first property. So, you know, I would say the best thing to do is to keep it simple and not overcomplicate matters. You know, I said at the beginning with the first question, make sure you can get a mortgage on the property. The reason for that isn't just because you probably need to, because you might not have enough money. But the second reason is, if a bank won't lend you money on that property, there's something wrong with it. And so, you know, don't buy anything the bank doesn't want to invest in either. And I say that because in some countries where you might be told you should invest, the bank doesn't like that asset class, or it doesn't like the risk because the legal title is wrong, or you have to buy it in someone else's name who's got a local passport, or any of that nonsense. So you go and buy somewhere, and I keep using the same places, but if you buy in Portugal, or you buy in Germany, or you buy in the UK, wherever, you're buying in a place where the bank will lend you money, the interest rates are low, you can get a very good yield, you can sit there and to some extent forget about it for 5 years, for 3 years, for 7 years, and just let the rent come in and pay the mortgage. But, you know, I would say, number one, do your own research. Don't stretch yourself too thin. Make sure you can afford the deposit. Don't buy anywhere where you can't understand the legal implications. You know, I bought and learned from Thailand and Poland and some crazy places, and you lose years of your life, you know, trying to make better returns, but taking unnecessary risks. Yeah. So my number one advice, go find a sensible market with a strong yield, with a good demographic. You're right, young people your age, that's where you want to be. Tech places where there's investment, there's infrastructure, there's a good population. I look at all these things even now. Property markets with great infrastructure and young people, good education, universities, startups, good technology, all that's where you want to be buying your real estate.
I think specifically because you mentioned Portugal as well. Portugal, I was there, I think 2 years ago in Lisboa. Beautiful place, beautiful people, very nice. They grow up in a sense that, you know, family is important, treat everybody with respect, right? And then, you know, they added another whole layer where they are not charging, I think, taxes on income that you do outside Portugal and so on. So very, very friendly. So do you see this is one of the top regions for property investment right now?
Yeah, for sure. I mean, we've been investing in Portugal maybe 4 or 5 years, and they've done a phenomenal job. If you remember, they were in real serious trouble during the GFC, the global financial crisis in 2009-10, and they've rebuilt that economy, and they've been very intelligent. They've encouraged a lot of foreign investment with visas and passports for people investing in real estate. They've been having tax breaks for people with income, worldwide income, which I would love, because that's not the case where I live. I have to pay my tax on everything, and they've been investing a lot in technology, because Portugal was an old economy. It relied very heavily on shipping. It relied heavily on tourism, and now tourism is still huge, but there's a big push now with technology, internet startups. So they've been very, very smart. And I think, and it's still relatively affordable. So many of our investors are buying in Lisbon, they're buying in Porto, which is obviously cheaper, but they're getting strong yields. Borrowing costs are crazy cheap. You can borrow for as little as 1.5%. You can get a fixed rate for 5-10 years on your mortgage, so you know it's not going to cost you any more. And so, we like Portugal. I mean, it's legally takes a bit longer than it will to buy in somewhere like the UK, but it's a very solid market. You can buy as a foreigner. There are no restrictions. You can get mortgages as a foreigner. So, we like it.
So, Tim, another question, as we just talked about Portugal as a market, which market you would invest in? right now? If you would have like one market that would be like the top best in terms of return of investment, safety, and so on, what you would feel like, what would be your market to invest in right now?
Yeah, I mean, it's a tough one because I'm obviously thinking with my head. You know, I'm in the UK. I'm a great believer in the UK property market. GBP is a very stable currency. Yes, interest rates are coming up a bit, but then yields are. You know, we just had a report today on our rental yields in the UK. We manage several thousand properties, and the rental yield on average has come up nearly double digit in the last 12 months. So I think rental yields are matching increases in borrowing costs. So I'm not too worried about that. So, you know, I'll be buying in the UK. The legal system here is the oldest legal system in the world for real estate. It's very stable. You can get good mortgages at low interest rates. So I'd be looking at probably Birmingham. I know I said before, it's my home city. So, the disparity in the price of real estate in Birmingham compared to London, when you're going to be able to get to London in under 50 minutes soon, it makes no sense, and people don't need to necessarily. I mean, it takes you longer to get to London if you lived in Kent, so which is almost a suburb of London. So, and Birmingham's now got Deutsche Bank, it's got HSBC, it's got a lot of big tech startups. So I think it makes a huge amount of sense to buy in a place like Birmingham. The yields are great. They're completely rebuilding the city with electric tramways. So probably my number one pick would be Birmingham, but you know, I like the UK. I like other markets in the UK. In the north, Manchester's very strong, and I love Germany. We've made great money for our clients in Berlin. But yeah, probably Birmingham would be my number one pick, I would think.
Tim, another question that I have is, you know, there's basically two, and you have something similar in the stock market world. There, is it better to go by your own into this world of you know, real estate jungle? Or do you go to an expert like you and your team? And what would be the pro and cons for both options?
Yeah, look, I think it's a great question. I think if you're living in Dubai or Abu Dhabi or anywhere in the world and you're looking to invest in international real estate away from where you live, then I think you need an expert, because you're not on the ground. You're not able to go do the due diligence that you would ordinarily do. You know, if you're living in London and you want to go and buy an apartment in London, quite frankly, get some advice from somebody that knows the business, but then you can go look at them all of yourself. But if you're buying an investment property and it's in Birmingham or Berlin or Lisbon and you're living in Dubai, then you're going to need some advice. You know, you need to understand what's the best location. Can I get a mortgage? What kind of rental am I going to get on it? So I would absolutely, in that situation, go and get some expert advice, as you would in the stock market. That never stops you, by the way, once you've got that advice, checking out the advice is good. Because, you know, we live in a world now where you don't just need to believe everything people tell you. You can go and do your own research. And when I mean research, I don't mean going online and reading a bunch of spam from other companies saying you should do this or we'll guarantee this, because there is also some nonsense on the internet. But you can go and look at how far is this property from a train station. You know, if I'm being told that the rental yield on this property is 5%, and the property is costing me $300,000, then I want to go and check on Rightmove or a property website. What is the average rent in that location that someone's paying for a 2-bedroom apartment? So there's no excuse for you to double check that you're being given good information. And I would always do that. But yeah, I think getting expert advice is absolutely essential if you're buying overseas investment property.
Fantastic. Now, weighing a little bit off the pros and cons for property investing versus stock market. Stock market is very liquid, right? I mean, you can sell your stocks, all of them, within a second if you want. That's not so possible with property investing. However, on the other side, you don't have this market volatility for properties than stock market. So what's your take on the real pros and maybe cons compared to stock market if you're talking about properties and real estate?
Well, look, if you need the money tomorrow, then you shouldn't be putting it in property. So, but you probably shouldn't even be putting it in stocks either. So you should always have some level of liquidity, right? So, but if you might need the money in a month to send your kids to private school or, you know, do whatever you need to do, then real estate is not the right investment for you. Having said that, most people should be investing over the medium long-term horizon. So anything from 3 years, but ideally 5 years to 10 years should be your time horizon with real estate. And so any good advisor will also always tell you that you should have different asset classes over different periods. So maybe you'd be investing in stocks over a 2 or 3 or 4 year period, or whatever your advisor's telling you. And real estate, you should be tying up money for the longer term. Now, remember, actually liquidity or lack of liquidity sometimes is a big benefit. So we did a webinar last week in South Africa, and one of the advisors we were doing this with told me a story that in 2009, he bought a property, or 2008 in London, and he paid £350,000 for that property, and it was rented out. He's living in Cape Town. And then the financial crisis hit and he was panicking. And his property went down. And look, in most places around the world, even London, the market got hit for about 6 months and that was it. So the market did go down. And his £350,000 property was worth £280,000 for 3 or 4 months. He was panicking. He was trying to sell it, and he had a buyer, and it fell through. And the buyer was panicking because of the stock market and Lehman Brothers and all that stuff. In the end, it didn't go through, and he kept the property because he couldn't find a buyer. And the property's worth £1.5 million now. So
wow,
the lack of liquidity was a huge benefit to him,
Nice.
and he's a very lucky man. So I think sometimes you can be protected from yourself by not being able to sell things too quickly. So if you're buying real estate, buy it for the medium long term. I've said, and I'll say before, and I'll say again maybe later, that also you can borrow money on real estate, which can help you with your returns by leveraging. But don't buy something where you need the money tomorrow. But sometimes not having the liquidity is a good thing.
Yeah, I know from my personal experience that, for example, if I talk to friends that just get into stock market, I'm usually the first person that they call up, why stocks can go down. So, and, some people are, by nature, maybe a little bit more emotional, attached to the money that they put in and the volatility, and they cannot stomach it. And Warren Buffett has actually a very interesting way to say it. He says, like, the stock market is as someone would come in front to your house and every hour would shout the price of the property, in your garden, in your face. So yeah. Some people cannot take the volatility, and then actually I say, maybe stock market isn't something for you. You can have similar returns in properties, so maybe properties is something more for you.
I totally agree. I think property sneaks up on you. I rarely look at my, I take a valuation every year. I mean, we used to do it. We can do every 6 months for our investors, but taking a valuation any more frequently than that is a waste of time. I think property is a great investment to leave, get your yield, pay your debt, and forget about it, and then have a look at it every few years and take a view on whether you think it's the right asset class for you to stay in. But it should be considered as a medium to long-term investment, and you don't get that volatility. It's not as scary, and maybe you might always make the same returns over a shorter period that you might in stocks. But I would argue, as a property guy, that I've made a lot more money in real estate than I would have done on the stock market, because I'm much more comfortable with it.
Yeah, there's maybe just a few people like you that have so much experience into the property investment field. So what do you think should be the top takeaways from this video for the people listening from all over the world?
Wow, there's so many, isn't there? So the thing I've said for years to people, and there's a couple of things you should take away, is number one, try not to get too emotional. I mean, property is not like stocks. It's a more emotive subject, and I think people sometimes end up buying property because it looks really nice, or it's got a nice sea view, and some sales guy tells you, oh, this is the best thing, look how beautiful it is. And it's nice to buy an attractive property, but you're not buying it to live in it, right? I don't know how attractive some of the stocks are that you buy. It might be mining. There could be some company that produces, cars, plastic. I mean, you don't even know where they are, some of them, and you don't get too carried away with how sexy they are. You look at whether you're going to make money on them. So I would not get too emotional about a property unless you're going to live in it with your family. Think about it as an investment, as a box. Yeah. Is this going to work for me? Is it affordable? Will it rent out? Can I sell it? And the things I've already talked about before. So that's number one. And number two, fundamentally, does it pass as the simple test of, would I live there? If I was in that city and I had a job and I was earning this much money, would I go live in that? How far do I have to walk to get on the tube station or the tram? And whatever the investment guy has told you, whatever advice he's given you or she's given you, spend 10 or 15 minutes yourself just checking that they're right. I mean, every investment we make, if we suggest you invest in an apartment in Birmingham and we say it's a 5-minute walk to the new metro station, we walk it and we write it in our investment report. That's how long it took me to walk. So you go online and you check on Google Maps, does it take that long, or is it really 25 minutes in the rain, or is it a 5-minute walk? So don't be emotional and just look at the numbers. Make sure you feel that for you that's a sensible investment.
Fantastic. That was a very, very great takeaway. So Tim, thank you very much for coming on today. It was very, very interesting to hear and take your advice. Obviously, the next time, hopefully we meet in real life and walk through the streets of Birmingham or Dubai. That would be, wishable from my end. For everybody who wants to know more about Tim and his great journey into his empire of properties, then we created a whole guide that you can download on the link below. So thank you very much for coming on today, Tim, and see you very, very soon.
Thanks for having me, Danny. It was great fun. Thank you.
What an interview. I mean, I really, really liked so many things that Tim said, some being his favorite markets to invest right now, and, why you should consider a professional to help you with all of these things that you might not have the time or the knowledge for. So please do me a favor, check also his guide that we mentioned in the description below. Let me know in the comments what you think. Are you investing in properties already, or are you more a stock investor? Are you planning to invest for your family, a residential real estate? Or are you planning to put everything in stocks? Let me know in the comments below and give this video a thumb up. Thank you very much for watching, and see you soon.